Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Here's the starting lineup for your 3 in 10 podcast for Friday, July 25th, 2025. Number 1, the China housing market in year 5 of a downturn. Number 2, DR Horton earnings. The stock jumps a stunning 17% on the earnings report, so we wanted to dig in and understand why. And number 3, commodities, a bull market brewing beneath the surface. So let's start with number 1. I attended a Bloomberg seminar on the Chinese property market this week. And what I learned is that a depressing story continues to play out. New home sales are declining again, down 11% year over year in June. Stimulus momentum seems to be fading amid U.S. trade tensions, sapping consumer confidence. Stimulus is fading because the stock market's doing well, and the economy seems to be holding up pretty well despite housing being in a depression, which is really interesting. What I learned at the seminar is that the room for incremental stimulus is limited. Politically, it's limited. China is now running the largest budget deficit in their history, somewhere between 6 and 8% of GDP. Those are not the official numbers, but those are the numbers that these analysts threw out as likely being the real case. 2025 new home sales are expected to decline another 12%, following a 66% wipeout already. 66%. Can you imagine if that happened in any other country? So despite deep-seated challenges which are prolonging the search for a bottom, there is really no end in sight here. This looks to be an L-shaped recovery, and structural challenges remain. There's just so much supply. It just can't be soaked up. The country's aging, and they've just got all the supply sitting there. So the analyst that we listened to at the seminar said to expect stagnation in the home market to continue. The public mindset has dramatically changed from 5 years ago, when individual investors wanted to put most all their money into residential housing because the stock market was busted, there's capital controls, the bond market doesn't yield very much. The problem is there's massive oversupply, there's demographic challenges, and these unfinished homes that are out there by the millions are undermining confidence. And the builders being in financial trouble is also undermining the confidence of the buyers. They don't want to buy homes if they don't think the homes are going to be completed. So China is probably going to be challenged to shift to a consumption-based economic model with housing in a depression. China is going to continue to build, in our opinion. This Midog Dam is a very good example. This is the largest dam ever attempted by humanity. It is multiples of the size of the Three Gorges Dam, which was the largest in history, and it is going to be the largest hydroelectric dam ever built, expected to generate about 65 gigawatts of electricity, which is just an astonishing amount. So the good news for China is they're going to have plentiful electricity. They're doing a lot to take the lead on that and leaving the rest of the world behind. Despite this bad news on the residential housing front, we notice that Chinese equities continue to power higher. There is a new bull market here, and if you look at the chart, it's carving out a saucer bottom, which is a great long-term technical pattern. And we just have to believe that there's almost nobody on board this bull market in China. China was quote unquote uninvestable for years. Everybody's out. So, of course, now a new bull market starts. And we also looked at the Chinese government bond market. 10-year yields are all the way down at 1.73%, within hailing distance of 1.6%, which is the all-time low ever recorded. So, interesting stuff from China, a mixed bag. We're going to move on to number 2, which is DR Horton earnings. So the stock jumped a stunning 17% on the earnings report. When that happens, we want to dig in and find out why. And we have followed this group since the early 1990s. We were very lucky to work with several of the great housing analysts of all time, including Barbara Allen and David Dwyer, Stephen Kim, Scott Solar, all great analysts, some of the best I ever worked with. And they frankly taught me about how this group works. And I follow housing because it's still a driver of the US economy. It's still very important. So we pay attention here. And you have to be early in home building equities. If you wait, you're late. And I think that's what's responsible for the huge burst in some of these housing equities this week. So DR Horton reported better than expected earnings and revenues, which energized the stock. But most importantly, it looks like the fundamentals have stopped getting worse. Things don't have to be good. They just have to get less bad for depressed stocks to rally. And the second derivative of earnings and revenues is improving. Things are getting less bad financially. And when you look at the group today, it's just a higher quality group. They're more profitable. They're producing higher returns on invested capital. They're returning value to shareholders through stock buybacks and dividends. The quality of the management has gone up. The quality of the business has gone up. So when you combine low expectations and low valuations, you get an explosion when the results beat estimates, which is exactly what happened this week, not only for DR Horton, but also for Pulte Corp. Mortgage rates still need to come down. The low-end consumer still needs to return to the market after being absent for years. But we think the rally has legs. We think investors are going to anticipate things getting less bad and that these home building equities can continue to rally. Imagine what would happen if we actually had a housing recovery in the US economy. Well, we'd get higher nominal GDP. Would the Fed still be able to cut rates? I don't know. It's an interesting thing to ponder. Now, number 3, commodities. We've had underinvestment in most commodities for the last 20 to 25 years. Returns weren't so good. So why invest? These were considered dirty, uninvestable, anti-ESG. And consequently, there's a supply story here today. A lack of supply. AI appears to me to be driving a reindustrialization, not only in America, but globally. There's a hunger for power, which requires commodities in order to deliver that electric power to drive the large language models that give us our AI answers when we query. Massive global fiscal stimulus and redistribution from the rich to the poor is part of this overarching super cycle for commodities. We know we have climate change investing that needs to happen. We know we've got deglobalization. We know we've got a structurally weaker dollar. All of these things are commodity bullish. And I noticed this week that the CRB raw industrials made a fresh 2-year high. These are the intermediate materials that go into economic growth. Also, the Bloomberg Commodity Index, X energy, and energy is the weakest part of the commodity story, admittedly. There's just oversupply. But when you take energy out, I noticed the Bloomberg Commodity Index broke out to a new 2-year high. Precious metals all are at or near 52-week highs, and some are at all-time highs. Our favorite commodities in order are silver, copper, and gold. We think these are the lead horses of the new commodity bull market. So investors need diversification. They need inflation protection, and they can get both in commodities. So there it is, your 3 in 10 podcast for Friday, July 25th at noon Eastern Daylight Time. As always, do the work, endure the pain of gain, and have investment courage.